Okay. So bonds issued at a premium. So again, when we're looking at a bond that's issued at a premium, we're looking at a bond that the stated rate of interest, what we put on the bond, is greater than the market rate of interest. Okay. So that means they're going to give us more cash up front for this bond, and then we're going to pay them more interest over time than the current going market rate. Okay. So here we have year one, January 1, year one, Northern Idaho Transportation issued the following bonds. $100,000 face amount bond at a 12% contract rate of interest, so that's how much we're paying them in our interest payments. Interest is paid semi-annually. It's a 5-year bond. The market rate of interest is 11%. So when the market rate is less than our interest rate we're paying, we're going to sell this at a premium. So, well, it tells us on this one, again, the contract rate of interest is more than the market rate, so it will sell for more than the face amount or a premium. Assuming the bonds sell for $103,769, this is how we journalize that. So cash received was the $103,769. The face value is the $100,000. So cash is debited for the full amount received, the $103,769. Bonds payable is credited for the face value, just like you would under any issuance of a bond. But now that difference, I take $103,769 minus the $100,000 is a premium. Premium on bonds payable, as you can see, has a normal credit balance. When we had a discount, we debited. The premium gets credited. The premium on bonds payable has a normal credit balance. Just like with a discount, we need to take that premium and amortize or spread it over the life of this bond. The difference here is, though, that they've given us more cash up front, so they've paid us more cash than the face value. So instead of it adding to the cost or the interest expense, a premium reduces the interest on the bond, okay, because they're giving us cash up front, more cash. So you can kind of ignore that up here. This is what we're doing, okay, as an adjusting entry. Every time we make, we're not doing that adjusting entry. We're doing this one when we amortize the bond. So every time we make an interest payment, interest expense gets debited, and we'll calculate that later. The premium on bonds payable gets debited, for just one period of that premium. So we would take the total premium divided by the total number of payments, just like you would on a discount. You're just spreading it out, only now we're going to debit that amount. And then the cash is the actual interest you're paying, just like on a discount. So the cash payment you make is always principal times our stated contract rate times the semi-annual rate. Okay, that interest payment stays the same. What changes is your interest expense. So for an interest expense on a premium, we're actually going to take our cash minus the premium to get the interest expense. Okay, so let's look at one because it helps when we have real numbers, right? So this was that same example. We had a premium on bonds payable of $3,769. The term of the bond was 5 years. So to get our amortized premium amount, we take the premium and divide it by the total number of payments. Term of 5 years, 2 payments a year. So 5 times 2, 10 total payments. So every time we make an interest payment, we're going to recognize $376.90 of that premium. Okay. So again, they calculated cash. They took 100,000 times, I don't remember what the interest rate was. It must have been 6%, right? Or 12%. It must have been 12% because it's 6,000. So they took 100,000 face value times 12% annual rate divided by 2 to get that semi-annual rate. So it must have been a 12%. So the cash interest payment was $6,000. We take cash minus the premium, just that amortized premium, to get the interest expense. Okay? So that's how it differs with the premium. Okay? The premium gets debited as we spread it out over time, and it reduces the cost of issuing that bond because they gave us cash up front. Okay, so that's reducing the interest expense over time. Okay. And again, the whole point of this is just to make the bond pretty comparable to the current market rate. Okay, so that's the whole point of discounting or putting a premium on a bond, is to make it kind of equitable to what they could get on the current market rate for bonds. Okay. Any questions on that so far? Okay. The last little part is just on bond redemption. We're not really going to go over that. You can read over it. But what I do want to finish up is the Chapter 11 practice. So from Canvas, make sure you go back into the Chapter 11 practice. Not the extra practice. We'll do that next. But just the Chapter 11 practice. And we should just have one left, number 3. So number 3 is an example of dealing with a bond issued at a premium. Okay, so we have Smiley Corporation wholesales repair products to equipment manufacturers. On April 1st, year 1, Smiley issued $20 million of 5-year 9% bonds at a market interest rate of 8%. So again, our contracted rate of 9% is greater than the market rate. So this is a premium. We received cash of $20,811,010. And $10. Interest is payable semi-annually on April 1st and October 1st. So on Part A, it says journalize the entry to issue the bond. Thank you. So what do I need to journalize there to issue this bond at a premium? Excuse me. Catching. What do I debit and credit? Cash, good. And how much cash do I debit? Very good. The cash we received, the $20,811,010. So we received cash of $20,811,010. What do I need to credit then?
Premium on bonds payable.
Good. Premium on bonds payable. For how much? How much is my premium?
811,000 or 10.
Yeah, they love to throw that $10 in, right? And 10. 811,000 and $10. Just did that just to mess with us, I think. And then what else do I credit?
Bonds payable.
Very good. For how much? Bless you.
20 million.
20 million. Perfect. Okay, so again, bonds payable always gets credited at the face value. Okay. Cash gets debited for the amount we received. They told us receive cash of $20,811,010. And then we just take the difference, cash minus the face value to get the premium. So they're giving us $811,010 above the face value. So this is a premium. Okay, so on Part B, now we need to journalize the first interest payment on October 1st. Okay, so how would I calculate that? How much cash? Let's start, we'll work kind of backwards. I like to start with cash. So what's the cash payment that we're making to them? How would I calculate that? How much am I paying them interest every 6 months? Or you can tell me how to calculate it, either way.
8%? No, that's not it. It's 9%.
Good, it's 9% interest on what amount? How much are we? The face value. Very good. Remember, interest payment is always the face value times the interest rate, but that's an annual interest rate. So what do I need to do to that 9%? Divide by 2. Perfect. So to calculate interest, it doesn't matter what type of bond this is. I take my face value, 20 million, times my contract rate of interest, which is a 9%. And I'm going to divide that 9% by 2 to get a semi-annual interest rate. So 20 million times 4.5%. So how much is my interest?
900,000.
Very good. 900,000 is the credit to cash. So I'm going to put that on the last line here. 900,000 is my credit to cash. That's the cash interest I'm paying them every 6 months. Okay. How much of the premium do I need to recognize? Or how would I calculate? How would I amortize that premium? So we have a total premium of $811,010. What do I need to do to just get 6 months worth of that premium? Okay, why would I divide by 10?
All right.
Very good. It's a 5-year bond, so I'm going to make 10 total payments. So I divide by 10 to get my amortized premium amount. Okay. So every 6 months, I'm going to recognize 1/10 of the premium, the 81,101. So I'm going to debit premium on bonds payable, the 81,101. So what's my interest expense?
The difference between cash and premiums and bonds payable.
Yeah, very good. We just take the difference, right? We take our cash payment minus that premium to get our interest expense. So the total interest expense on 6 months of this bond is $818,899. $818,899. Okay. Any questions on the premium, understanding the premium? All right. And then part C just says, well, why was the company able to issue the bonds for more than the face amount? The market rate was what? Less than. Very good. So the market rate was less than the stated or the contract rate of interest, so we issued this bond at a premium. We were able to sell it, get more cash up front. Okay. Any questions? Any questions on bonds so far in general? Face value, discount, premium? Yes, ma'am.
There's a question on the homework that says something about using exhibit 5 and exhibit 7.
Great question. We're actually, I looked at the homework and I actually created an extra practice that I thought we would do 1, possibly 2 like that if we have time. So good question. Yeah. It's dealing with present value. Honestly, like what those tables are for is coming up for the bond proceeds. So, you know, they've told us so far how much cash we're receiving, but how do we know how much cash that, you know, they just told us, oh, this is our stated rate, this is the market rate. How are they getting that cash amount? And using those present value functions and future value functions actually help us to come up with those proceed amounts. It won't be on the test, but I thought it was good to kind of go over present value and future value. So any questions on anything else before we look at that? Okay. Well, if you go onto the Canvas homepage, you will see kind of right below the Chapter 11 practice, I threw out a Chapter 11 extra practice. So go ahead and load that in Cengage, Chapter 11 extra practice. And we're going to look at those tables and kind of discuss and do one together, so that way you'll be able to do your homework without struggling through it at least, right? Again, you won't be doing any present value or future value on the test, but you do have it in your homework. Okay, so here we have on July 1, year one, Livingston Corporation issued $46 million of 20-year, 10% bonds at a market rate of 11%. Okay, they received cash of $42,309,236. Interest is paid semi-annually December 31st and June 30, and the fiscal year is the calendar year. So the first two entries, we're just kind of reviewing issuing a bond. So is this bond being issued at a discount or a premium? Discount. I guess it kind of says right there, doesn't it? But yeah, it's a bond discount. Really tough question. But again, we're receiving less cash than the face value, so we know it's a discount. And again, if we were looking at the interest rates, we're paying 10%, and the current market rate is 11%. So when our stated contract rate is less than the market, we're discounting this bond. So what would I journalize to show the cash proceeds of issuing this bond? Cash, good. And how much cash are we debiting?
$42,309,236.
Perfect. The cash received, which was $42,309,236. What else am I doing? Discount on bonds payable, good. And do I debit or credit discount?
Debit.
Debit, good. And how much is my discount amount?
$3,697,64.
Very good. $3,690,764. $3,690,764. And of course, we got that taking the face value, the $46 million, minus the cash payment. Okay, so we just subtracted to get our discount. And then what do I credit?
The bonds payable of $46 million.
Very good. Bonds payable is credited for the face value, the $46 million. $46 million. Okay, so that's issuing a bond at a discount. And then number 2 says the first semi-annual interest payment on December 31st. We want to journalize that and the amortization of the bond discount. So what do I debit and credit for the first semi-annual interest payment? Any ideas? Interest expense, good. And we'll calculate it in a minute. So we know we debit interest expense. Perfect. We are going to credit discount on bonds payable and credit cash. Perfect. Okay. Well, we know we're going to have to calculate interest expense last. So what's my discount on bonds payable?
$20,275.
That is incorrect.
Maybe it's a 369 divided by 40.
Well, it's 2 times.
2 times 1.
Yep.
Yeah, that's 40, yeah.
Mhm.
About 40.
Right, good. We're going to take that total discount amount. What'd you do? You don't even know. He's like, I don't even know.
No, I did the thing on the bonds payable, I did percentage 11 out.
Oh, okay, you did percentage. Okay, so yeah, we're going to take our discount, the $3,690,764, and divide it by the total payments made on this bond. So it's a 20-year bond, 2 times a year. So we're making 40 total bond payments. So we're taking the full discount amount divided by 40. And then we're crediting discount on bonds payable for 1/40th of the full discount, right? Just one payment. So what do you guys get? $92,269. Very good. 92,269. And what's my cash payment? Very good. Yeah, we're going to take our face value of 46 million, and then we have a 10% bond, and we want to make that a semi-annual rate, right? So, in essence, we have 46 million, and then it's a 10%, yeah, 10% divided by 2, or 5% interest, semi-annual interest rate. Okay. So what's my cash interest payment? Just 5% of 46 million. Anybody? Anybody? Thank you. $2,300,000, 5% of 46 million. And so what's my total interest expense? Or how do I calculate it? Very good. The total cost of issuing this bond every 6 months is a cash interest payment of $2.3 million plus 1/40th of that discount. So we add them together. So $2,392,269 is our interest expense. Okay. Part B, what's the next interest payment?
The same.
It's the exact same. So no, you don't have to do any calculations. So we're just going to debit interest expense for the same amount, $2,392,269. Discount on bonds payable gets credited, $92,269. And cash gets credited the $2.3 million. And we would make that same journal entry twice a year for 20 years. So we would have 40 journal entries that look just like that over the life of this bond. Okay. Well, it says determine the total interest expense for year 1. Well, how many interest payments did we make in year 1? One. Right. This bond was issued on July 1st, so we only made 1 payment of interest in year 1, that July or December 31st interest payment. So when it's asking you that, it's just the interest expense of $2,392,269, just 1 year, which was just 1 payment of interest. Okay, so on number 3, it is just the $2,392,269. Okay. Number 4, will the bond proceeds always be less than the face amount of the bonds when the contract rate is less than the market rate? Yes. Yes. Okay, so we'll always discount a bond. The face value will always be less, or the proceeds will always be less than the face amount when the contract rate is less than the market rate. All that's saying is we're always going to discount a bond when the contract rate is less than the market rate. So that was all kind of review of what we covered last week. It's a good refresher. But number 5 is the fun stuff that Danielle was asking about. So we're talking about doing the present value of the face amount and the present value of the semi-annual interest payments, and then the price received for the bonds. So that, of course, gets a little bit tricky. They give us different exhibits. So it says compute the price of the bond, the 42,309,236 received for the bonds by using the present value tables. Okay. Your total may vary slightly from the price given due to rounding differences. So basically, again, the whole purpose of this is to figure out how they got that 42,309,236. You know, if we have a stated rate of 10%, the market rate's 11, The face value was 46 million. How did they get these cash proceeds? Well, they used present value functions, okay? If you've taken personal finance, you may have done some present value functions. So the whole idea of present value is figuring out what the value is today of something that you might receive in the future, or that's what we're doing in here. So the present value of the face amount, well, we're not paying them that face amount for 40 or 20 years, right? We'll be paying them back the face amount of the bond in 20 years. Well, what happens to the value of $1 over time?
Depreciates.
It goes down, it declines, it depreciates. So the value of $1 today, is it higher or less than if I gave you $1 in 5 years? Less than. And that's also due to possible interest too as well, right? So we have the decline of the value of $1, or how much money is actually worth. And we have, well, if I gave you, say I gave you $5,000 today, if you put that in an interest-bearing account, in 5 years, you're going to have a lot more than $5,000. So that's kind of the whole idea. On interest-bearing notes, giving you the face value up front, you're going to have a higher value. Present value is greater than what it is if I gave it to you in 5 years. So when we're looking at the present value of the face amount, the present value of some future payment is always going to be a lot less, okay? Because you weren't getting the interest. Now, we also know, though, that we're paying them interest, right? So they are getting interest. But we want to calculate, again, the whole purpose is the price received for the bonds should equal this price that they gave us, okay? So what we're going to do is we're going to use these exhibits. Exhibit 5, Exhibit 7, these fun exhibits. Okay. So on your present value of the face amount, okay, on the present value of the face amount, we're going to look at Exhibit 5, and we're going to look at the present value of $1 for 40 semi-annual payments, because we're making 40 payments. But we're going to look at the market rate. Okay, the whole purpose of calculating the proceeds on the bond is considering the market rate. So that's where it kind of throws students off. So when you're looking at present values, you want to go off the market rate, which in this case was 11% annual. So our semi-annual market rate is 5.5%. 11% divided by 2, 5.5%. Okay, so calculate your semi-annual market rate first, and then we're going to use the 40 payments. 40 payments. And we're going to look that up. So I go to Exhibit 5, and I make that much bigger because, yeah. And then we look. How you use these charts is you look at the number of periods or the number of payments you're going to make, and then you find the intercept of the semi-annual interest rate. Well, this one's 40 payments, so I have to scroll way down. Okay, here's the line 40 here. And then I have to find my 5.5% semi-annual rate. So that's the fourth column. So that's my returned number there. That 40 payments, my fourth column is the 5.5% interest rate. So I'm returning 0.11746. Okay, 0.11746. So I'm using the present value of $1 at compound interest. So the present value of the face amount, I take that intercept that I found and multiply it by the face dollar for the face amount of 46 million. Okay, so I use Exhibit 5. I look at the total payments and the semi-annual market rate of interest. Okay, the market rate. Yes. So whatever I found on my exhibit 5, which I got 0.11746, I multiply by the face dollar, the face value. Because this is how much the present value of $1 is in this situation. So $1 is worth 0.11746, not very much, right? Times all 46 million. Okay, so I should get the present value of the face amount is $5,403,160. Just round to the nearest dollar. So $5,403,160. Present value of the face amount. Because remember, we're not giving them that face value for 40 years. But we are going to pay them interest, right? Every 6 months, we're paying them $2.3 million in interest. It's a nice little chunk of interest payment. So the second computation, I'm going to calculate the present value of the semi-annual interest payments. Okay. So on the second one, I'm going to use Exhibit 7, and I'm going to look at the same 40 payments at 5.5%. Okay. So Exhibit 7, 5.5% at 40 payments. $16.04612. Yes. Okay. 16.04612. In this table, we're looking at the present value of an ordinary annuity. Just so you know which table we're using. Just make a note. Exhibit 5 and then Exhibit 7. And the value, the present value of the semi-annual interest payments, I'm going to take that factor times the $2,300,000 in interest payment I make. Okay. So I take the value I returned in Exhibit 7 times $2,300,000. That's the cash interest I pay every 6 months. Okay. So the present value of the semi-annual interest payments should be $36,906,076. $36,906,076.
Why is the face amount less than your interest?
Because we're actually paying them the interest payment every 6 months, so they're receiving that over time. The reason that present value of the face amount is so low is we're contributing, what's the present value of 46 million? Well, we're not paying them that 46 million for 20 years. So it's worth so much less because they're not getting interest. They are getting interest, but just the face amount, we're assuming it'd be like, if I gave you 46 million today versus 46 million in 20 years. So in 20 years, if I gave you 46 million, it'd be worth 46 million. I gave it to you today, it's worth 5 million. Because if I gave it to you today and you put it in the bank, you'd earn interest and it would be worth more in the future. So again, it's just due to the fact of always better to receive money today versus in the future if you invest it properly. But they're getting all of that interest over time. So we're giving them interest every 6 months. And if they were putting that in the bank, then they're earning interest on that interest, okay? That's why it's worth more. So the price received for the bonds, I just add those two together.
Is that the interest rate thing?
Yeah, I looked on Exhibit 7, looked at 40 payments at 5.5%, and returned the 16.04612, and multiplied it by the interest payment I make every 6 months.
For the cash portion.
And so to get my price received for the bonds, I just add those two amounts up. And you should get the cash proceeds that we actually received for the bond, the $42,309,236. Okay. So the purpose of number 5 is really just to show you how those cash proceeds are calculated. Again, you'll do it on your homework, so just follow the steps we just did, but it won't be on the test. But I wanted you to kind of understand that we're using present value functions. If you're comfortable with Excel, you can use present value functions in Excel instead of using the tables, because Excel uses those tables to calculate those amounts. There's present value and future value functions in Excel too. But the tables work. Any questions on that?
That's your deficit.
I don't think we have time to do the next one. Really, the next one's the same. It's just working on a premium. But as far as when you're doing your homework, it's the same exact calculations. Okay, so you're still using on the present value of the face amount, you'll use Exhibit 5. Again, just make sure you're using the semi-annual market rate and the total number of payments. Okay, and then the present value of the semi-annual interest rate. Just make sure, again, you're using those same two numbers, whatever numbers are for that problem, and you're doing Exhibit 7. Any questions? Is that going to help with that homework problem, if for those of you that have started it or done it? Okay, good. All right.